Fundamental analysis is one of the most important parts of doing your own Forex analysis, and overlooking it could be one of the biggest mistakes you can make in trading. In this video we will go over one important part of the fundamental analysis, and that is analyzing the interest rates of all noteworthy central banks and the impact an interest rate change can make for you as a trader. I will go over what interest rates are, why they matter for the foreign exchange market and therefore for you, and also how you can incorporate interest rates in your own strategy, or at least consider how it can change your trading. So first of all, what are interest rates? Every major central bank in the world, for example the ECB, the Fed or the Bank of England, has their own interest rate. The Fed has an interest rate of 0 to 0.25%, while the Bank of England has an interest rate of 0.10%. The interest rate is thus a percentage, and as you might have already thought of yourself, it is the percentage interest one can ask for lending money. So this can be the percentage your domestic bank asks for a loan, or the percentage you get on the money you lend to the bank, in other words, your savings. Among other things, the interest rate influences. So these interest rates are changed quite a lot over the last years and decennia by all central banks all over the world, where the interest rate of Bank of England is now 0.10%. It used to be 5.5% back in 2007, to show an example. So why do central banks change their interest rates? Well, grab your pencil because this might become difficult. So if you would rather just hear why interest rates matter to you or how you can use them in your trading, skip this part. You still there? Okay. Interest rates change because they are one of the biggest drivers in the economy. When the economy is doing well, people are spending their money, and that brings about inflation, which basically means that the same amount of money becomes worth less. To go against inflation, central banks raise the interest rates, which makes saving more attractive, which means less people spending their money and also less inflation therefore. The cost of this is that the economy will shrink a little bit, so to boost that up again, the central banks lower their interest rates, stimulating spending, which drives the economy up, and the central banks are always in this never-ending circle where they sometimes have to change the interest rates. And while this sounded very quickly, most of the time multiple years will go over this. Now on to the more interesting parts. Why do these difficult economic measures matter to you as a Forex trader? Well, interest rates don't only mean things for individuals in one country, they also signal things to people all around the world. When one country raises its interest rates, people become interested in that country and the currency. They also want to invest their money against those higher interest rates. So basically, relatively high interest rates make a currency stronger and more attractive, while relatively low interest rates make a currency weaker and less attractive. This is very important for Forex because the interest rates of the central bank of, let's say, the US and Europe can single-handedly steer the trend of the Forex pair euro against the US dollar. When the US interest rate is higher than the EU one, it means the US dollar is more attractive and thereby stronger, signaling a downtrend in the pair, and vice versa. And we will end with the part you have all been waiting for probably. How can you incorporate this huge fundamental factor into your trading? Well, I have summarized 4 ways of using interest rates in your trading, and I will describe them all in detail now. The first one is using the interest rates of two currencies in the pair you are trading to determine your own bias, or the trend for the pair, according to the interest rates. You can find out what interest rates the central banks of a currency have at this moment of time and develop a bias in favor of the currency with the highest interest rate. Secondly, you can trade the news, as they say. This method involves you listening to the long briefings of the central banks when they are publishing interest rates and trading accordingly, or you should be very active in spotting surprise cuts. And here equals a surprise cut in the interest rate, or a lower interest rate than expected, as bearish for that currency, and you should sell. And a surprise raise, or a higher than expected interest rate, equals a bullish signal, and you should buy this currency. This requires very fast execution though, and most of the time banks do not actually surprise cut or raise interest rates. And that's why I would not recommend this way of trading. The third way is carry trading, and I will make a full separate video on carry trading, so wait for that. But in short, it is basically profiting off the difference in interest rates between two currencies by holding a long or short position, depending on who has the highest interest rate, for a very long time, sometimes up to multiple years. The last way, and the way I use, is to simply avoid trading in such times. Some things cannot be predicted, and what they say and do at monetary meetings involving interest rate talks is one of those things, in my opinion. So when I check the economic calendar, which I always do before every week, and see something involving interest rates, I will simply not trade that day in that currency, or I will put my stop loss of my positions in that currency at break even, basically so I cannot lose money.